So what do you think the market is mostly worried about at this moment?
Well, listen, I think energy you brought up is a big component of this. You look at something like the XRT performing pretty poorly, even though some of the very largest names in the XRT are doing well, like Casey's. But retailers in general are having a trouble. I think a lot of that has to do with what's going on, obviously, with gasoline prices. I don't think people really look at gasoline prices the way they do stock prices, let's say. $3.80, $3.85 a gallon is effectively the highest of the modern era outside of the COVID era spike. So consumers have to deal with that at the same time they're making the student loan payments and all the other stuff that's going on. So that's what's happening there. But I will emphasize on the energy side of things, it's not just the inflation print. I mean, the demand story has been, and you well know this, but for viewers who may not, the demand story globally has been very strong. It's been strong in the United States. It's been strong in Europe. And believe it or not, for a lot of people, it's been strong in China, because a lot of what's driving oil demand is not just the industrial activity in China that everybody thinks it is. It's transportation. So as long as everybody's still flying and shipping goods around the world, energy is going to be well supported for the demand side of things. And on the supply side, obviously, you've got the Saudi cuts, et cetera, et cetera. Yeah. So you've really got this two-pronged thrust behind energy prices. We've liked energy, and we still do.
It is backing off today, obviously just taking a breather, but it is interesting that you have had this upturn in enthusiasm for energy as a long-term story. That's the way it works, right? When the prices go higher.
Price drives sentiment.
But also, you say 380 is the highest on a per-gallon national average. That's true, but we were here 9 years ago for a little while. The economy was much smaller. Wages were much lower. Yeah, it just sort of changes the equation, it would seem, in terms of how it can be absorbed.
Yeah, and also remember, cars get more miles to the gallon.
Exactly.
There's all sorts of changes. The economy as a whole consumes less energy, consumers in general, but the economy as a whole consume less energy today than we did 3 years, 5 years, 10 years, et cetera, et cetera. And so in that sense, it's not quite the damaging, it might not have the damaging effects that, let's say, the 1970s would have had. And I would also add, because a lot of people are talking about the 70s, on a percentage basis, the move in oil in the 1970s dwarfs, of course, anything that we've seen today. But listen, I mean, $90, $95 Brent is not nothing. $3.80 a gallon is not nothing. And I think, again, it's what you see in the retailing names. And when you look at like fourth quarter GDP, which is continuously getting revised down, a lot of it is going to be on the back of consumer spending, which is probably going to take a hit. Maybe not as large as people expect, but it's probably going to take a hit on the back of a lot of the things that we're discussing.
Yeah, you're starting to see some anecdotal stuff about, holiday spending intentions have eroded to a fair degree. So the psychological effect, without a doubt, is there. Big picture, though, what the market has been undergoing in the last 6 or 8 weeks, it seems kind of textbook. I mean, almost too much. Where it seems August comes along, we have to have our little shakeout and our little downside test and our choppiness, and it's continuing into September, but it's low intensity. It's not as if there's a lot of panic.
The VIX.
And yeah, exactly. It seems like it's this sort of slow bleed or just this kind of low volume, maybe just kind of reconciling of share prices with the uncertainty of the underlying economy. Where does it lead?
So I'll say two things. One, about the low vol sell-off, if you will. There were a lot of people who came into this month that said, sure, this is a poor period of time for the market, but when the market's up very strong, so listen, we can refine the data one way or the other.
To finish your point, September has tended not to be so bad
when the rest of the year is up. And listen, a lot of this is data mining to the nth degree. But the larger point, the second point I wanted to make about your textbook argument is this feels and looks a lot to a lot of macro strategists akin to the 05, 06, 07 period. The last time you had real yields up at this level, the last time you were late in the Fed tightening cycle, et cetera, et cetera. There's obviously more to it, and we won't bore the viewers, but it feels a lot like that, where the equity market continued to make highs, credit spreads continued to tighten. A lot of people don't realize it, but you were tightening in the credit markets until the summer of 07.
Right.
The equity market peaked in October of 07. A recession began in December. So there's a lot, I think, a lot of similarities between now and then. In terms of what does this mean, I still come down in the camp that, like, you can't. The Fed's going to win. The Fed is going to win. They always win. They're probably going to make a mistake. The idea of the soft landing has gained steam. I've endorsed the higher probabilities of a soft landing. But at the end of the day, I think those economic and market truisms, so to speak, exist for a reason, and I imagine the cycle will be no different.
Right.